All right, we're moving into our final session now. Thank you all for staying for the duration of the event. Very excited about this. It's meant to be a straightforward, candid approach to the capital markets and the debt climate today. Real estate exchange, a top 10 list for navigating today's financing environment. Post-pandemic micro factors and macro factors are having a significant impact on commercial real estate transaction. Unexpected inflation has persisted. Inflation rates have risen rapidly and is a challenge to deliver new housing products. Simultaneously, global factors such as the war in Ukraine and the Mideast region are driving continued uncertainty. Predicting the future is no easy task. However, thought leaders on stage now will offer tangible and proactive advice in a unique top 10 list. It's a straightforward discussion. Any owner, operator, broker, dealer would want to observe. So what we're going to do is we'll make 10 statements about the industry, and the panelists will react and offer advice. So I'd like to initially introduce the panel. We'll start with Andrew Dexter, Assistant Vice President, Team Director of Commercial Financing, First National Financial. Andrew Dexter, good afternoon.
Hi there.
We have Sandy Harrington, VP, Managing Director, Team Leader in the London office at CMLS Financial. And Jason Hingston, Director of Real Estate Development at Meridian.
Good afternoon.
Okay, so statement number 10 on the top 10 list. The capital stack does not reflect current times. The capital stack does not reflect current times. Andrew.
So taking this up here this afternoon, I couldn't decide if I was going to be optimistic or pessimistic here. So I'm going to be in the middle. So look, I mean, it's a very different world from a financing perspective. You know, it is a lot more illiquid there than it used to be. I think if you're buying or if you're developing assets right now, it is very challenging to get your financing. If you are successful to get your financing, it's a much lower level of debt that you're used to. I think mezzanine debt, you know, Ian alluded to that earlier. It can be lucrative. It is very difficult. People that are in the mezzanine debt world are struggling across the board with maybe some loans that aren't going well and various challenges. Equity should cost a lot more. So I would say that it's a very different capital stack than it used to be. A lot less senior debt, maybe very challenging illiquid debt on the mezz side and on the land loan side, and equity would be dramatically different as well.
The capital stack number 10, capital stack does not reflect current times. Sandy or Jason, thoughts?
Yeah, I can chime in on that. I mean, I think the capital stack is a reflection of an assessment of risk. And in the real estate market, certainly on the development side, the risk curve, we're up the risk curve. And so from a senior lender perspective, that's going to cause a little bit of constraint. And so when we talk about the capital stack's change, it's changed relative to what it had been in the low rate environment. There's a perceived increase of risk, and risk is an equity coverage for the most part. And so that's what lenders are looking for. And there's secondary forms of equity in mezz, as we spoke about, that can come in. That's an entirely acceptable addition to the capital stack, but certainly you're not going to see the ceilings of senior debt reached as what it was in the pandemic.
Sandy?
Well, someone has been contrarian. Sorry. So my team, we had a very strong year in student housing financing this year, which is a bit unusual because it comes in waves. I've been doing PBSB for 30 years plus, so through a lot of different cycles. So just to give an example, because I think it gives some context. So this year, over 500 million of student housing, about half of what we've done out of our team's book this year, and done a lot of CMHC. Obviously, everybody has. So construction and permanent, but that also covered some bridge debt, structured debt, conventional debt, portfolio debt, one acquisition. So we did see and did deliver debt for our clients. It's different than what it was, for sure. And you know, you're up against resistance, but you always have been in the student asset class. And what we're hearing today, which is helpful for sure, and love what Bo and I are doing with bringing the macro information, it's going to be very helpful because every step that we do for financing student requires education. It's related, but we have to educate the lending world each and every time. And there just hasn't been a consistent flow of deals of scale and quality to keep a constant flow of sources. So that changes the stack for sure. But there's always a place. It comes at a price and it comes at a level.
Number 9, loans are now determined by underwriting debt to coverage ratio and not valuation. Loans are now determined by underwriting DCR and not valuation. Andrew.
Well, it used to be that you'd have these fights with your borrowers about what valuations are, and Henry would come in and say it's a 3 cap, and we'd say it's 4, and this would go on and on. But now it's different, right? So we're no longer talking about cap rates because we talk about debt cover ratios. So if we need to be at a 120, 125, 130, really today's interest rates speak volumes in terms of how much debt you're going to get, and so your loan amounts are going to be capped by the debt cover that the property produces. It's no longer a question about where cap rates should be. I think the guys earlier alluded, there aren't any transactions in the market. We don't really know where cap rates are. I think when you look at private portfolios, if you look at pension funds, nobody's really revaluing their portfolio. But on the public market side, it speaks volumes, right? Where it's, the stock price is for the public companies, and they're trading at huge discounts to their net asset value. And so if you look at the math there and you see what the implied cap rates are, certainly there's a very big divergence from where the perceived cap rates are from today's owners and developers. But nonetheless, the loans are being underwritten based on the debt cover that the property can support, more so than the cap rates that we would underwrite them at.
Sandy, do you want to take a shot at that? Loans are now determined by underwriting DCR and not valuation.
Yeah, absolutely. Debt cover dictates the proceeds, but the process of getting your loan, both on the borrower side, as Andrew talked about, everybody wants to talk about what do you think the value is, and the lender side, same thing. What do you think the cap rate is? And there's always some background uncertainty. But again, just to bring it back to the student housing, there's hardly ever been transactions. We've got a couple of portfolios that will never trade. They're my clients. They're never going to sell a thing. And once in a while, one pops up. So when we do something on the other side of the country, you're dragging from some comparison to multi-res or somewhere else, and you're projecting a cap rate. So we're in the same position today. Debt cover is actually easier. It's monetary. It's easy to calculate.
Jason?
Yeah, I don't think the fundamentals of it have changed much. From a lender perspective, we were always interested in what you could afford to pay in terms of a monthly payment, annual payment, that debt service coverage versus how much we were going to go up the leverage curve. And with respect to student housing, I should say there's one point that I think is a positive in the environment that we're in. And we've heard it earlier today that we are seemingly at the peak of interest rates. And so we're talking about the need for development of student housing. And anything getting into the ground today, you're talking about a 2-year completion. Well, we don't necessarily have to underwrite at the interest rates today. We will take a bit of a conservative view, but we can take a look then at providing debt through the development period, looking at the DSC, which is always going to be important, but utilizing assumptions that are forward-looking that may actually help out with the equity side of the equation while keeping the DSC coverages in line.
Number 8 on the top 10 list. Number 8, there are very few transactions occurring. Andrew Drexler.
Should we just go to number 7? There are no transactions, really. It's the same on the apartment side. There's not much to really say there. I think we've seen portfolios come to market on the apartment sector that have not traded. I think expectations for cap rates haven't moved much, and people still expect to get yesterday's prices but it just doesn't work with today's interest rates. So I really expect this year to be very slow from an acquisition perspective. I think we'll be busy with refinancings and whatever's in the pipeline. I don't expect any meaningful transactions to occur in terms of either the apartment sector or the student housing sector.
Sandy Harrington.
Yeah, I think the acquisition is going to be really tough. It's hard to finance acquisitions, probably more so than development, because development, you go on the premise of hopefully you're bringing an advantage to the market on your cost side, and then what are the proceeds I can get? And CMHC if you're patient enough, you can still drive some, we're getting some very high levered loans from them. And that gets you into the game. But buying stuff, it's tough.
Jason Hingston of Meridian.
I don't have much to add. The stabilized assets are simply not moving in the current environment. We are seeing some development proposals come across our desk, but there's a challenge there as well. But the cap rates, there's thin volumes. It's not happening right now. I think the word the Canadian Real Estate Association used was hibernation. We're seeing that on the commercial side.
Number 7, slightly longer statement. In today's environment, you have to be on your game and have deep pockets. Understanding the difference between net worth and liquidity. I'll repeat it. Number 7, in today's environment, you have to be on your game, have deep pockets, and understand the difference between net worth and liquidity. Andrew Drexler.
Well, I think that's really the most important point in real estate right now. I think it really comes down to liquidity. I think, notwithstanding the CMHC debt availability, I think it's a very liquid debt market that we're in. I would say this is probably the most liquid that I've seen in my 22 years. And it's serious. So I think borrowers think that they have big net worths, which a lot of them do, but it's tied up in properties and it's not accessible. It becomes very difficult to refinance a lot of these properties. And so it comes down to, how much cash flow do you really have? And if you're in development, like some of you are, if you have cost overruns, if your lender has issues, if you have to contribute more equity, then what happens? Where does that liquidity come from? So I think as a lender, our focus on our entire construction book and in evaluating borrowers is really how liquid are you and where does that liquidity come from? I can tell you that we have public company clients that talk about liquidity, but when you look through their balance sheet, it's lines of credit, it's undrawn lines. That to me, that's not liquidity. That's access to debt at the moment. It can be withdrawn. So what's the real liquidity that you have? And the other thing is, what about your partners? Who are your partners and how much liquidity do they have? And what does the guarantee structure look like? If you've signed up joint and severally on a loan and you have liquidity, but they don't, project runs into trouble, then what happens? Where does that liquidity come from? So I think liquidity is the most important thing that borrowers should be focusing on going forward for the foreseeable future.
Sandy Harrington, CMLS.
Yeah, Andrew said it right. I mean, I think beyond the large borrowers that have their own issues as you go through the process, just as you said, depending on the liquidity that they have access to. But anybody mid-size or smaller, I mean, that's one of the bigger dilemmas you're always up against, or their little partnership group. Somebody's got some strength, most don't, and they're bringing almost enough money to do the project, but nothing behind it. And I had one this week that just talked about, well, if we get to the end of the project and there's a problem, we have a couple of properties we could sell for a couple $1 million. So it's quite strange to hear that in today's environment when things aren't selling. They're looking at that as their backstop, and that's not going to get you your loan.
Jason Hingston.
Yeah, liquidity's always been front and center on the development side, but it's increasingly become important on the stabilized side where the refinance risk is not limited to the retail residential market. You've got commercial loans on stabilized assets that are coming due. Many times if it's conventional financing, you're talking 5-year terms. So straight line that any given time of 1/5, 20% of all student housing stabilized loans are coming due. And right now you're talking about cash flows that no longer work at current interest rates. And that's where, as lenders, we require the liquidity or access to liquidity to right size these loans. We don't necessarily ask for it, but we certainly want to be seeing it in today's environment.
Number 6, political change might drive a shift for certain product types over others and may boost student housing. So number 6, political change might drive a shift for certain product types over others and may boost purpose-built student housing. And Andrew Drexler.
Sure. Sandy, is this your question? I mean, look, I appreciate what CMHC is doing. I think the federal government's done a great job in trying to create liquidity. They've come up over the years with excellent programs, financing programs. They have recently come up with additional liquidity in the Canada Mortgage Bond. I think that's crucial for the apartment sector. At the same time, the federal government has a very strong immigration policy, which further perpetuates this issue that we have with housing affordability and supply. But I mean, from our side, on the debt side, it's really just the political side is driven by CMHC and the programs that they provide, which help us provide the liquidity to you. And I'm not sure what else.
Sandy Harrington.
Yeah, I think when we were phrasing this discussion, one of the preliminary setups for this panel, what we were alluding to was over time, the international students were a very small subset of what was being considered for the demand. And now it's a very different, it's a big piece of it. So obviously costing a lot of stress, but at the same time, you have to prove it out. Again, educate your lender side, because we've had the political pressures, the geopolitical pressures of all of a sudden, you know, the students from China, which were predominant for 5 years, and a lot of properties were being designed and delivered for them. They're much smaller than before. The students from India, again, we're in some geopolitical challenges with them, be polite, but whatever. The lenders look at that from the risk perspective and go, what if it's shut off? What if? So lenders want to look at it saying, I'm looking at it over a period, and certainly CMHC say this, you know, over the amortization, but you've really got to look at over at least 10 to 15 years. Are we building into something that property is going to be viable over that period of time? And right now, you don't want to deliver something that's specific to a politically charged situation.
Jason.
I don't have too much to add to what Sandy and Andrew have said here. There's political risks exist across the board. We have elections frequency that is sometimes more frequent than getting developments from start to finish through the approval cycle. So there's always going to be a political risk in how we as lenders are viewing these assets and our loans against them. And certainly with the immigration, I mean, we heard it talked about earlier today, what was being built and designed and built for primarily Chinese international students is not necessarily what's fitting the bill for Indian international students. And from a lender perspective, we need to be aware of this, but I don't know if there's something that can be done about it. And certainly we build into the equation the fact that, okay, that may be the political view today, but tomorrow, if that doesn't exist, what's our backstop? And there's varying forms of that. And we look to our borrowers to educate us in plan B.
Right. I'll make one final comment on that. Just in hearing the dialogue today about design, and then the Indian student that wants to live in a much a denser situation per unit. I know we will see some projects come to the table designed for the Indian market where they'll have a bunch of bunk beds and there'll be 6 or 8 to a room, and they'll say we have a market for that, and we'll have to fight them to say that's not sustainable over a period of time, and there'll be some pressure.
Number 5, design plans are being reconsidered to project and interest cost. Repeat it, design plans are being reconsidered to project and interest cost. Andrew Dresser.
I'm sure I understand the question. Can somebody help me out?
Yeah.
So I would just actually continue on this point about design. So again, look, we're lenders, right? Lenders in Canada are extremely conservative. Take your most conservative people that you know, and then drop 3 levels below, and that's what the lending world in Canada is. So if I'm, you know, Ian Husted or Henry Morton, and I'm trying to come up with this design for a building that I'm going to start construction in a year or 2, and then it's going to take 2-3 years to build, and then I have to lease it, and then I'm going to put on my takeout financing, and I also have to think about what the financing exit is going to look like and where interest rates are going to be. And there's a lot of things you got to think about. So now when you're adding in the complexity of, wait a second, we're in a fight with India, and all of a sudden, what if the Indian students disappear? We lost the Saudi students a long time ago. You know, I'm hearing a lot about Filipino students and Brazilian students. They have a different income composition. So they're looking for small units because that's all they can afford. They don't have money necessarily to eat out, so they want to cook in. So these are very complicated design problems because, again, you're coming to your lender ultimately to get your financing, and the lenders are going to say, well, actually, I'm not that big on micro units, or I don't really understand this, you know, 400 square foot, 4-bed design. So it's very, very complicated. I think it goes back to what does the financing environment look like, and how can we mitigate a lot of that risk, and then how can we build the design of what the market maybe wants, keeping in mind that the lenders are very particular and risk averse in Canada.
Sandy Harrington.
Yeah, I just think, and when you talk to the actual developers that are in the room here and outside, I think that they do want to deliver a diverse product mix within their buildings. And I think that's been proven in other markets, in Bonard and some of the other providers in Australia, et cetera. I think that's the safe way. And I think the lenders can understand that better than something too particularly designed that may have pressure on getting the loan proceeds you're looking for to justify it. So those things have to really be considered as you know, that's such an early stage discussion. I mean, ultimately when it comes to debt, you don't know until it's almost too late that you've got the wrong design.
Jason Hingston.
Yeah, I think there's been a rethinking of exactly what building you're going to be putting on a site, and certainly the density surrounding, which is a factor of the interest rates and costs. Mid-rise has always been a quick hitter. You're kind of in and you're done, and you limit your construction risk, but it's the least efficient floor plate from a cost perspective and wasted space. And that's certainly not going to help the economic model. And so in some of the borrowers that we've been talking with and dealing with, and we work with them on the land side, they've actually gone back to the well to go and re-entitle the property to seek higher density, to improve that efficiency ratio. And I mean, we've got a housing crisis, so it's not that contentious to say that we should be getting more housing on a site. If you can go up 4 extra stories and have no material impact, then you should be able to get it. It's not as easy as that in reality, but that's what we're seeing, what I'm hearing from many of our borrowers.
Number 4, the student mix has changed and design of new buildings must reflect this evolution. So number 4, the student mix has changed and design of new buildings must reflect this evolution. Andrew Drexler with First National.
I don't know that there's much more to add than what we just talked about. I think it's just this complexity of trying to understand your target market in the future, because development takes a very long time, right? So I'm not sure we have anything else.
Sandy Harrington, CMO.
Yeah, I think we're covered.
I'll only add that we're not experts in that question at all, but we'll look for feasibility studies in terms of our underwriting. And we're very reliant on third-party experts to show us and convince us that what is in place in terms of a design perspective has the breadth of market, and that market will be there when we need it to be there.
So up to number 3. Number 3 is today is an operator's environment and not for financial engineers. Again, today is an operator's environment and not for financial engineers. Andrew Drexler.
So I think in the previous panel, I think it was Eric who said, you know, it's very difficult for merchant builders going forward. So, you know, I look at it that real estate was a way to invest for the long term. And to me, the advantage of real estate was that you were supposed to put meaningful equity and it was supposed to give you a good return. And that return was really tax sheltered, right? Because of the depreciation that you're getting. And somehow over the past, you know, 10 years, because of all the quantitative easing we've had around the world, interest rates are driven to very low levels, which, you know, created ample opportunities to access cheap financing, which brought a lot of people into the industry, which led to huge valuations, low cap rates, a very favorable financing environment. So basically all that led to a lot of people becoming merchant builders, merchant developers, or even people that bought assets and then flipped them, either refinanced them or flipped them. To me, that is over now for a very long time. I mean, we're now in an environment where you have to contribute meaningful equity. And if you're going to contribute meaningful equity, you need to have real returns on that, right? But again, the returns are not going to be, you know, in the 20s like they used to be. They're going to be a lot smaller, and you have to make sure that you've done your due diligence, you understand the NOI that you're getting on existing buildings. And if you're going into development, again, you have to have a lot of margin to account for the fact that interest rates could stay at this level for a prolonged period of time. So just make sure you're getting compensated well for putting up significant equity. But I think the days of financial engineering, merchant building, you know, I hate to say it, but I think that's coming to an end. And I think you have to go back to thinking that real estate is very much a 10 to 15 year investment vehicle.
So number 3 for Sandy, today is an operator's environment and not for financial engineers. Sandy Harrington.
Yeah, I think it's in the low rate environment. I mean, it covered a lot of not the best practices, and it didn't make the best operators shine. Some people that just weren't great at their business were still able to hang in there. So this is just basic business, and it's not just in student housing, it's everything. It's a time, because money's got a real cost to it now. So you want to make sure that your net income is protected, that it's, you're actually hitting your pro formas, because you're going to be judged on those, and it's not going to be just somebody trying to buy it at a cap rate and flip you out, because that's not going to happen. It's going to be real results reflected accurately.
Jason Hingston, we're ready.
Yeah, I'll try to add something new here. These guys cover most of it before you get to me. So there's the operator side is super important. If you haven't done it before, don't go seeking senior debt to get it now. We're looking for experienced operators, proven operators. That's how it goes. The reason being is that now with the interest rate environment, we're in a 1 month, 2 month, 3 month delay. Those carry costs materially affect the budget, and they're usually on the back end. And so it's when the debt's advanced, it is a massive number, at least compared to what it was. And we're not looking to go down the road of needing extensive delays on the back end of a loan. And that's where our operators come in versus those who on paper show us a beautiful pro forma.
All right, we're up to number 2. Number 2 is having a plan B. Everything may not be okay and rates may stay elevated. So repeat that again, if you hear it. Having a plan B. Everything may not be okay and rates may stay elevated. Andrew Drexler.
Let's go to Jason Kingston from Meridian for this one.
Woo!
I don't have an answer for this one. Like I said, we're in the risk environment. Plan A is always what we're going to be looking at, but you're going to get the question, what happens if things don't go the way that you're thinking? Contingencies, whether it's hard-coded contingencies in a development budget or operational contingencies within a management plan of a stabilized asset. There needs to be discussion, there needs to be thought in this current environment into, okay, we've done our best. This is the way we see the world, and we as lenders can agree. But if it turns, we need to know our capital's protected, and we need to know that you've got the hands on the wheel, and you're driving that bus. That's not our business model. That's yours. We're there to facilitate your operation and not become your operation. So I think that's how I would sum up the Plan B discussion.
Sandy, number 2.
Yeah, I mean, stuff happens all of the time. So we've had to do, because of situations, some bridge loans, some top-up loans. The money's always available. It comes at a higher price. So then you want to control your duration. So that's where you're working with your developer borrowers. If that is what we need to do to get us to the next step, let's try to control the duration. So it's the line item of interest cost is still within your control and capacity. We're not trying to create problems. We're just trying to get to the next step where a solution is different and better.
And I would just add, again, the focus on liquidity, like really understand your liquidity and understand who your partners are and what their strengths are, what the quality of their covenant is. And I would just take it one step further and say, what's your relationship with your lender? Is this, have you been using your lender as a commodity for the past, 5-10 years, or do you truly have a deep relationship? I think this will really test the quality of your relationship the next few years. I hope I'm wrong, and I have a view on interest rates that I really hope is wrong. But my question for our borrowers is always, are you prepared? Like, what if interest rates stay where they are today? When you factor in inflation, which doesn't seem to be going away, when you factor in the Fed lessons from the 70s when they thought they had inflation covered and it didn't, and so they're going to stay at this level for a very long time. Then you have the credit spread, which gets added on top of the bond deal. So therefore, interest rates could still be hovering at this level or higher for the foreseeable future. And if you have development projects that are terming out, and all of a sudden you're asked to contribute a bunch of cash to reduce your construction loan, can that happen? Where do your partners get that money from, right? So this is a real plan B. The plan B should not be, well, I'm going to sell this asset, because like Sandy said, you're in a market where there's no liquidity. And by the way, it might not be a 4 cap like you think it is. So have a real plan B and really understand, well, how many projects do you have? Where are you going to have equity calls? where's the money going to come from, and understand your partners and understand the strength of your relationship with your lender.
One quick thing, Brian. Yeah, something that we do a little bit differently, a little more aggressively possibly, but we're doing a lot of interest rate buy downs when we get to the end of the day, and the adjustment between revenue achieved and the current interest rate of the day, which can't change every day. So on a good day, that differential is not bad. But if you take the reduction in proceeds based on the change in rate, that's a really big number. And you're kind of locked into that number, whereas most people we deal with have liquidity for the rate buy down, and that's more effective.
Up to number one. Here it is. Number one, disruption creates opportunity. There will come a time when tolerance of lenders expires and the show begins. So again, number one, disruption creates opportunity. There will come a time when tolerance of lenders expires and the show begins. Andrew Drexler.
Andy, you want to go first? You haven't had one yet.
What was that again? Yeah, no, I mean, I've been through a lot of different cycles because I've been around this business longer than probably anybody else here, but whatever.
Almost as long as Henry.
So
He old.
in different cycles, and again, in the low rate environment, and most people have been observers of it, it didn't create nearly the same transactional opportunities, because you had people that would clean up the messes of created by the tension of bad partnerships, the tension of not being competitive, all the things that usually come into play in a business. In a low rate environment, it's like it protected everybody. So when you get some disruption, that will put some people, the cracks we're always seeing in the system already with some of these things, and people are hovering. They've got liquidity, they're waiting, and that's part of the problem you don't have for transactions right now. They're waiting to make sure they don't overpay, but that will also create, I think, a good environment. It's just there will be answers and there will be things to talk about.
Jason.
In a word, I think consolidation is what we've got. Through the pandemic, there were borrowers that were chasing returns, and real estate certainly had very attractive returns. Those returns were predicated on the macroeconomic environment, and that macroeconomic environment's not the same. So I forget who it was in the previous panel. It was Ian. Sorry if I got it wrong, but talked about starting to field inbound calls, and inbound calls are going to start to be coming in to larger players of, can you take my asset and what do you need? Because I'm underwater, the bank's not happy, and I need to get rid of this. And so I think we're going to start to see some consolidation, which is an opportunity for those who've stayed prudent, who haven't necessarily joined the hype when we had our hockey stick growth. So certainly there'll be some reward for those out there that fit that category.
And I got called on one of your loans this week.
So that came, Drexler gets the final word.
Well, I mean, I'm not sure if it's disruption. I mean, disruption to me is driven by innovation. I'm not sure there's innovation here. I think it's really just surviving the next 2 years. I keep going back to liquidity, but if you can survive the next 2 years and you're still around, that means that you did okay. I do think a lot of people, unfortunately, are going to be out of this business soon. I would caution people just to keep in mind that the debt environment is very fragile, and in Canada, we have never really dealt, or certainly during my lifetime, never dealt with any real losses and a situation where lenders have lost a lot of money. From my boss, who's been around a long time and started First National, he tells me that when times get tough, lenders will go after the good borrowers because they need to reduce their exposure. So if you're reducing your exposure on mortgages and debt, and I think, Henry, maybe that's what happened to you, but the lender will come and call your loan. And so you have to pay down that loan. Again, where does that money come from? And so sometimes, even if you're the good borrower, it doesn't necessarily mean that you can get by. And again, you have to make up for maybe the developer partner or the partner that you have. So I think if you can find a way to survive the next few years, I think you're going to be okay. I personally love the student housing asset class. I do think it's the one asset class that is best positioned for long-term growth. It's got the inflation hedge built into it. You've got the annual turnover that's significant. It's a fragmented market. There's still lots of opportunity. But I think it's about caution and survival for the next couple of years.
All right, so that will conclude our top 10 list. Strategies for navigating, a top 10 list for navigating today's financing environment. Didn't have any questions built in, but we can take a question or two if you'd like. Anyone with any questions about the top 10 list? Hotech from Doma Student Housing. They're saying in the next 3 to 6 months, any major changes coming in the lending environment? Any big changes?
I'm not in the business of predicting policy here. I think that's, I'd look pretty foolish on this stage 6 months out in suggesting what the government's going to do, but certainly the HST, or GST, HST to follow announcement, and more specifically, I think that as it relates to student housing, it's going to drive quite a bit of interest and possibly new developers who hadn't been in the space into the space, because historically, let's just say condo development had about a 15% profit margin on it if you were out buying the land. If you got land lift, that's different. But the same building, same envelope, same floor plate on a rental basis, and depending what cap you picked, you're probably at 6% on a profit basis. And so there was always a drive to build that under condo. Now, when you're talking about the reduction of you got 8 to 13% coming off, you start to even out that equation. And more so, it is a long-term financial asset for a portfolio. So it'll benefit beyond just its initial uptick in profit. So I think it's going to drive, as a specific policy item, that HST long overdue, but that's going to drive quite a bit of what would have been condo developers into purpose-built.
Sandy? Changes next 3 to 6 months.
Well, I think we're in a very interesting time. I mean, there's just a lot of push and pull in so many different directions. I think underlying it all is opportunistically, I expect with all the different, well, the laser focus, as ineffective as it may be from all the levels of government, you know, to somehow fix the affordability crisis, they're going to do some things that they will overshoot the market, and that will create some tremendous opportunities for people that can move. How they move fast enough, because again, people aren't sitting with a whole bunch of sites waiting to go. So that will hold up some things. But I think, and I've told a number of my clients, you know, this would be for the not faint of heart to jump in and do things, because we're coming out into a better environment in a few years. Usually you're coming out into a crappy environment with reduced revenue opportunities. So pick your spots, you're ready to go if you've got the money.
I would just add there's a new CMHC president that's going to be elected soon. Romy Bowers, who's done an amazing job, is leaving to take a job at the IMF. That will set a new direction for CMHC. CMHC has essentially been almost 100% of the liquidity source over the past, 2 years or so, and it continues into this year. If anything changes there, I mean, right now they've added the 20 billion to the Canada mortgage bond. That's huge in terms of liquidity. But if anything changes, or if they eliminate the Canada mortgage bond, that could be problematic. But it'll be interesting to see, considering that they've provided it. They've been essentially the sole provider. Nobody lends on the balance sheet anymore, and we've done a good job, I think, as a group in bringing more student housing loans into CMHC, and they've been accommodative on that. But it'll be interesting to see what happens with the new president, and I've heard there are a few board changes coming as well.
Okay, the top 10 list. And a bonus question, including Andrew Drexler, Assistant Vice President, Team Director, Commercial Financing, First National Financial, LP, thank you. Sandy Harrington, VP, Managing Director, Team Leader, London Office, CMLS Financial, thank you for joining us. And Jason Hingston, Director, Real Estate Development at Meridian. Thank you all for participating and contributing to the top 10 list. We hope you found this as a valuable takeaway for the SHURE GTA event. Thank you.